Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Don Durrett of goldstockdata.com. Man, Don, we're in the bull market.
We sure are. It's pretty exciting. Darrell, thanks for having me back.
Yes, for sure. You know, I asked this question of a recent guest, and I'm curious in your thoughts on it. How do we not waste a bull market? How do we avoid wasting a bull market, especially for investors that, you know, get into some of these positions move up, you know, they see the number go up nominally on screen, and they want to get out of the position, and to my understanding, we're still early in this cycle, and so curious in your perspective on that.
Yeah, it's a big subject. You know, it's really difficult to, you know, because everybody has kind of different objectives, different. Like I talked to a guy yesterday, and he was only investing 3% of his total portfolio into gold and silver miners, but it was still a big chunk. And so a lot of people, I mean, and some people, they're investing everything, you know, 100% of their portfolio in gold and silver miners. So it's a big gamut, if you will. But the one way that you don't want to waste this is to recognize what's happening here, and that we're still early. So you don't, I mean, some people think that it's, you know, we're at the top here. You know, silver's at $90. Every time silver does this, it tops out and then it corrects for 20 years. And, you know, I'm not going to touch it with a 10-foot pole kind of attitude. And that's actually wrong. We're early. The best, and I can give lots of reasons why we're early, but I think, and we'll kind of start there. Like right now, I can find 50, which is amazing to me, 50 very high quality 5-baggers. And another 25 high quality 3-baggers. I mean, and then we can go another 25 high quality 10-baggers. I mean, we're early here. You know, Newmont's a little over $100. I feel that it's easily going to 400. So that's a 3-bagger from here. Not quite a 3-bagger, almost a 3-bagger. Mm-hmm. But if gold goes, that's at $6,000 gold. So if gold goes even higher than that, some people think $7,000, $8,000 gold. So Newmont, which is a bellwether, still has that kind of upside, 3 or 4-bagger upside. I mean, the largest gold producer in the world. Silver miners will outproduce Newmont significantly, and mid-tiers and juniors will outproduce it. But one way we know that we're early and that, you know, you don't want to miss this rally is I've been using free cash flow. Free cash flow is kind of the key to the valuation of these companies, in tandem with the balance sheet and in tandem with future, you know, kind of what we're seeing, you know, go out 3-5 years. But if a company has kind of all the attributes, so let's look at like Newmont, for instance. Newmont doesn't have a clean balance sheet yet. They have about $5 to $6 billion in debt. But their free cash flow this year, the current run rate is $13 billion. So at the end of this year, and they have currently about $6 billion on their balance sheet. So at the end of this year, if they don't pay down their debt or pay out huge dividends, they'll have about $15 billion in cash on their balance sheet in 1 year. And so their balance sheet will be cleaned up, which is what we need. And then the other thing that they have is huge margins. So their margins right now are like 50%. So we're $4,600 gold, and their margins about 2,300, 2,200, somewhere there on the current run rate at 5,600. ASIC around 17. So we have the silver miners, their margins are even higher than the gold miners. But the key here is free cash flow. So it's all about, you know, balance sheet, margins, and then future, where you're going, you know, and as long as we don't have high inflation over the next 2 years, we're going to get multiple expansion. And this is what I mean by being early and not kind of missing it. So Newmont's free cash flow margin right now, which is kind of an equivalent of PE, I like to use free cash flow as the cash business, is under 10, whereas the forward PE for the entire S&P is about 22, 23, which we know historically should be around 16 to 18. So that's high, almost at mania phase. Whereas in the miners, they're not even normal yet. So there's going to be three phases. And this happened. The reason why we're early is this happened for the last two bull markets. So we've only had three bull markets in gold and silver: the late 70s, the late 2000s, and now. And both times in the late 70s, you had multiple expansions. So you had kind of low and then normal, which would be Newmont around 15. And then you have high, which would be Newmont somewhere around 18 to 20. And then you have mania around 25. So we have those three phases still to go. We got normalization, which will happen this year, which will take Newmont to around 15. Then we go to 27, and we go to high, and then we go to mania. And so I think we have 18 to 24 months before we really get into kind of a high valuation, if you will. And then once we get up there into that mania phase where the multiples are screaming high, kind of like today what we have in the S&P, where everybody's Warren Buffett goes, I'm not touching that. I'm going cash. You guys are overvalued. Until we get there, we're early. And so that's how you're going to miss it. And so like right now, if you look at the fundamentals of gold and silver, they basically, in my opinion, scream that gold's going to trend upward. The gold's not, the trend is up, not down. And that's not, if you look at the macro that's kind of pushing gold, there really isn't any macro that says gold's going lower, right? Mm-hmm. You don't see it. So the chances are pretty good, probability-wise, that gold's going to go higher, silver's going to follow, and the multiples are going to expand as the balance sheets improve. And so this is kind of a best case scenario for investors. So I've been waiting for this for decades. I thought we were going to get it in 2011, 2012, but it didn't happen. It would have happened if the economy wouldn't have came back up. But the Fed basically, we didn't have inflation back then, so the Fed could take rates to zero, print at will, and basically get the economy back on its feet again. This time, it's going to be a lot harder for the Fed. So there's a very good possibility that this bull market kind of has legs here and could go all the way to 28, 29.
Mm-hmm. Yeah, for sure. Yeah, it's going to be definitely harder for the Fed. I mean, they're going to have to backstop the government, and because you have other nations that are buying gold over treasuries and such, and so it's definitely a different dynamic today. I'm curious in your projections on earnings season that's coming up. So many companies have earnings they're going to be reporting next month and such, and so curious in what's your kind of projection there.
So the earnings are basically going to come out in February, and so the key here for earnings, it's kind of bizarre, but this is what's happening today, is that the S&P 500 is high. It's like 6,900, and as long as the S&P is high, gold and silver are going to be high. They're kind of, because gold's been correlated to the S&P since February, March of 24. And so since they're correlated so strongly, in February, I'm anticipating between now and middle of February, some of the earnings will come out late February. But over, say, the next month, I expect the S&P to kind of hang in there and not have a significant correction. I don't think we'll have one until March. So if we're right, if the S&P hangs in there and even goes a little higher, gets above 7,000, 7,100, anywhere in there, then gold is going to maintain these levels, 45, 46, maybe even 4,700 in February. The one key to earnings is the market is it looks back at the last quarter and then it looks forward to the next quarter. It doesn't really care about, 2 quarters back, 2 quarters ahead. It's the market. The people that control the market are the traders, and the near term controls everything. One little bad news release and stock goes down 5%. Like Aya they came out with a news release saying that their chairman was leaving, and he was 80 years old and he's retiring, and the stock goes down 5%. 5% on an announcement of the chairman's leaving. It's so everybody is so short term focused, and so but example after example of that, a company like Northern Star, they missed on their production for 25, and the stock goes down, like 10%. It's like, look back and then look. We're only going to look forward 1 quarter, but Northern Star has a beautiful project called Durrett. I think they might have renamed it. That was the company they acquired. They acquired Durrett. They're building that right now, and the market's like, we're not going to give you any value for that because you're not going into production next quarter. So the stock goes down because they miss, and yet they have a project that's coming online that more than offsets the miss, and the miss isn't even that significant, but yet now the stock goes down. This isn't, my point is that the market is very, very short-term focused, if you will. And so going into February, because they're short-term focused, if the S&P stays at these levels, and then they announce the miners, especially the gold miners, silver miners as well, they announce their earnings, which are going to be good, then they could pop pretty significantly here. So we could see, we're going to find out. Some of the big names kind of announced first, Newmont, VRIC, Agnico Eagle. They'll announce, and it's possible that we could start to see some multiple expansion. In other words, we could see Newmont possibly get to an 11 or a 12. It won't go better than a 12, but we could see it get to 11, maybe a little higher than that, as Newmont basically bounces in tandem with the stock market, in tandem with gold being higher, and then in tandem with, people starting to recognize that gold's probably, you're not going to correct. But right now, Wall Street, so I'm expecting really solid earnings. So the average gold price in the last quarter was $4,150. So $4,150, that's about $1,800 margins. Those are pretty darn solid. That's average. So some companies are going to have $2,000 margins plus, which is pretty amazing when you think 2 years ago gold price was $2,000. Now we have $2,000 margins. So I think the earnings season is going to be really good, but you don't want to own these mining stocks. This is probably the better takeaway from here about earnings season. Okay, the earnings season is going to be very, very strong, and these miners are probably going to tick up a little bit. But people are ingrained with this idea that you make money quarterly and annually, and you're always trying to make money. You're always trying, your portfolio always trying to go up, 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 up. That's not what mining stocks are about. Mining stocks are cyclical, speculative bets. You shouldn't even be playing with this stuff. You should only be invested in gold and silver mining stocks if you're willing to lose money. Not expecting to make money, willing to lose money, especially to be willing to be underwater. Most stocks, I would say 90% of the stocks I've ever bought have been underwater at one time or another because of the volatility, the nature of this stuff. These are not strong companies. These are companies that are totally dependent on the price of gold and silver, which goes up and down. And so you shouldn't even really be that concerned about quarterly earnings. The only thing that we're trying to do, we just don't want a company to, so you buy a company for its story, and you buy a company with an expectation of the future, and it shouldn't be 12 months. You should never buy a gold mining stock. I'm going to make money in the next 12 months. That's just reckless gambling, reckless speculating. You need to think in terms of, in gold mining stocks, more 24, 36, 48, more long-term investing. And you know why you bought it. For instance, so if you own a mining stock, this quarter isn't really that, not nearly as important as what happens over the future, because in order for you to do well in mining stocks, gold and silver prices have to go up. If they just stay flat, inflation will slowly hit the cost. The cost will go up, If gold, silver prices stay flat, you don't make any money. You might lose money. So you're speculating on higher gold and silver prices. That's the only reason we own these things. And I believe we're getting higher gold and silver prices. So any stock anybody that's reporting earnings, all we're really looking for is the story changed. We don't, okay, they had a good quarter, but did the story change? Did their costs go up? Did their costs go down? What's the trend of their cost? But we're not thinking so much about, oh, fabulous quarter, oh, great, That's how you think in terms of, an investment, Microsoft, Google, quarter to quarter. They do quarter to quarter. In mining stocks, we don't do quarter to quarter because gold and silver are too volatile. What's the underpinning of gold and silver? I would say 75% of the value of a company is gold and silver. And the underpinning of gold and silver is kind of the overall macro data. What drives gold and silver, right? If gold and silver prices right now were under $3,000, I might not even be talking to you. I mean, gold and silver are the whole price of gold and silver is the key to it all. That's how.
We may not have any viewers at that.
Yeah, he might not. Nobody's even interested, right? So this is all about gold and silver, and it's not about quarter to quarter. It's more about year to year. I always say, focus on the prize. Like for instance, 1911 gold. They really haven't performed well. That's a development story in Canada. They haven't really performed well since August. So all the other companies have done 100% up or something. And they're like flat to down. And people are saying, this is my worst performer in my portfolio. We don't own 1911 gold for the near term. We don't even own 1911 gold for 2026. It's irrelevant. It really is. We own 1911 gold because we're speculating on its potential. And its potential can only be realized in the future. It's realized through two things. Well, we can go three, but really two things. The first one is that they have to get into production, right? Until they're in production, it's a nothing burger, right? We're not going to get paid. It's a development story. So until they get into production, we're just sitting here waiting, and we're watching and waiting. We bought it because it was a story we liked because we saw the potential. Okay, so the first thing is getting into production. The second thing is the price of gold when they get into production.
Yeah. Right?
So they're going to get into production in Q1 27, most likely. Once they get into production, if the price of gold is over $5,000, they're going to have high margins. So the third thing, was the third and final thing, is the first quarter results. And they show their free cash flow. Now, they're mining in Canada, in Manitoba. So if they throw out, $100 million in free cash flow, they're in Canada, right? Gold prices are 5,000. They're going to get at least a 10 multiple all day long, right? And so that's why you got to know why you own a stock, right? And so that's why you own it. You own it for the future. You don't own it. So what if it's not performing in 25 or 26? It doesn't matter.
George and his team, a 16-year VRIC employee building some of their largest mining operations on the planet. We started a drill campaign, from the drill campaign moving into a full engineering report and study. We came out with our pre-feasibility study in 2021, and it showed a really impressive economic case for advancing the project. We'll have final definitive feasibility out in December of this year. So in the space of 4 years, fully engineered, fully permitted. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
I'm curious in your perspective on B2Gold, as well as, 'cause I know they have their Goose Mine project, and then also Equinox. I know they recently did the deal in Brazil. And when I was talking to Rick Rule, he mentioned like this is a classic Ross Beatty move to typically find an even higher quality project with those funds, and he's done this multiple times over the course of his career and had some success doing that. And so I'm curious on B2Gold and Equinox.
Yeah. So one thing I have learned, I've been doing this for 20 years, is that you want to own quality. you want to be overweight quality, and you want to be overweight quality producers. Now, quality for me is it can be an exploration developer or a producer, but quality is quality. And when you own quality, you have an edge. And when I'm in VRIC, when I speak, my talk this year is going to be on how do you get an edge. And I've learned how to get an edge. And so these companies, B2 and Equinox, the way that you get an edge is that entry is very important. And these stocks are still cheap. So you don't have to worry about, overpaying your pricey stocks. So that's one of your check boxes. So I have check boxes on these are both producers. So on producers, you have about 8 check boxes, and you want to find a company that checks all the boxes. And both of these companies do check all the boxes, but in each box, you want to rate them. And I'm going to go over this, from 5 to 9. And then you don't want to, if a company on those 8 only has a couple of 5s or 6s, then you probably, maybe I don't want to own this company. But B2, the only issue really with B2 is half of their production comes from moly. And as an investor, you go, how much confidence do I have, in moly? Is there going to be a problem there? So it really comes down to that. If you don't have a problem with their Fekola mine in moly, then it's a really good hold. So I talked about how free cash flow multiples are extremely low. And so this is a good example. In Africa, it's hard to find one that's over 5. Most of them have a free cash flow multiple of 2, 3, 4, or 5. And I think B2 is like 3, which for a major, it's kind of ridiculous. And so I think that now Ghana actually came out. There was a news release yesterday that Ghana is going to triple the royalty rate on the lower end. That was really nasty. And so that's going to prevent double-digit multiples in Africa, which is kind of ugly. So here we have B2Gold. So B2Gold, I thought that they had a really good shot at double-digit multiple. That would be like tripling their share price just on multiple expansion alone, go from 3 to 9. But I still think that it will triple from 3 to 9. But maybe they won't get double-digit. Maybe they will, maybe they won't. But I think 7, 8, 9 is definitely in the cards for B2. Now, the key again is moly and Fekola. And I personally am okay. I don't believe that Burkina Faso and Mali are kind of the 2 troublesome countries in Africa right now because of the political situation. But those are 2 large gold mining countries. And I don't think that, I don't really think they can nationalize the mine. They can do kind of what Ghana did, keep raising their taxes, right? And that's probably going to happen. But Fekola still is going to generate a lot of free cash flow no matter, even if they put 50% overall taxes on it, even they're still going to make money. It starts to become problematic once they get to 60 or 70%. But Ecuador showed us that if you go to 70, nobody cares. Nobody's going to invest anymore. So I think that we're going to find out where the cutoff is, but I think the cutoff's around 60%. 60% of profit basically goes to the government. Because once you get to 70, they tried 70 in Ecuador, and everybody said, "No mas, we don't want it. We're not coming. We're not building mines. If you're taking 70% of our profit, we're not building any mines." And so, I think 60 is probably about as high as they'll go, and I don't think that's going to kill B2. So I'm okay with the B2. And by the way, B2 has a very good management team. They're a major. They're going to grow production. They're a shark. They like to do acquisitions. I love sharks. Equinox is it's somewhat similar to B2 in that it's been an unloved stock. It's had high cost. The reason why they divested out of Brazil is their highest cost mine. They basically said, look, if we're going to be in the big leagues now as a 1 million ounce producer, we want our ASIC to be in our peer group. We don't want to be outside our peer group. So the peer group is around $1,700, $1,800 ASIC. And this takes them there just by doing this. So they were about 19, somewhere in there. They were above their peer group. And they said, hey, we want to go down to our peer group. So I understand that. I actually would, if I was the board, I would have kept the mine because I'm so aggressive on the gold price. If gold goes to 6, 7, 8,000, that mine down in Brazil is worth a lot of money. It would have generated a lot of free cash flow. I don't care how high the ASIC was. You get to $7,000 gold. I mean, you're talking 250,000 ounces of production. Do the math on that. I mean, the free cash flow would have been absolutely huge. But, you know, these companies, they tend to be conservative. They wanted to match their peer group. But I'm a fan of Equinox. It's actually one of the undervalued majors. And, you know, it's going to be a strong performer. They have a nice pipeline, too. Their pipeline is to grow 500,000 ounces. So they're currently at 750, and their pipeline is to add 500 to go to 1.2. I think they'll get there. And so, and they're going to do it through quality mines. So I'm a big fan of Equinox. Yes.
Okay. Thank you for that insight. We got VRIC coming up, and we talked more about a little bit about the macro earlier in terms of the time horizon people should have, and you know the driving factors for gold are still intact and such for higher gold prices. So people are going to be introduced to a lot of different mining companies, and you go and you actually research many of these companies. I mean, you have a huge database on gold stock data, and I'm curious, what should investors be thinking about? What questions should they be asking? You know, obviously they could go to a service like Gold Stock Data and subscribe and get your insights on companies that they may come across at the conference, but people are going to be talking to CEOs. They're going to be talking to investor relations and such. And just curious what wisdom or advice you have for people that are looking into opportunities.
Yeah, well, people watching this that are new are actually very lucky. And the reason why I say that is because when I started doing this, and I started buying juniors in 2004, I had no source, nobody to tell me how to do it, right? So, but I wrote a book after I learned how to do it. There was no books. 2004, there was none, zero. So I wrote my own book, and I keep updating it. So the 12th edition is coming out in February. It'll be out by the end of the month. So order that book on Amazon and read it. I don't make very much money selling books. It's like less than 1 week of my income is book income. You don't make any money selling books. There's not that many people that, you know, invest in gold and silver, so it's a niche, right? And so that book is comprehensive. It will teach you what you need to know on these gold silver miners. I'm telling you, it's a book, 12th edition, is very comprehensive. You will learn how to analyze these stocks, and you will learn the risk levels of these stocks. And the one thing that in that book, I added a new appendix for this edition, and it's basically it's called Getting an Edge. And in that book, it shows you how to get an edge for producers, developers, and explorers. And so I firmly believe, after a lot of work, a lot of analysis, that you can get an edge investing in these stocks. Now, this isn't about trading. I'm not trying to get an edge trading. That's not what my book isn't about. My book's about fundamentals. It's about buying a stock and then having the patience to wait to get paid, if you will. Now, the key to it all is the gold and silver price. So you're basically positioning yourself. First example is, we'll use Equinox. We just talked about Equinox, right? So if you buy Equinox today and the gold price, let's say, goes to 6,000 and stays there, which is, it's a pretty big jump from $4,600, right? Goes to 6,000 and stays there. So they're going to have high margins, let's say over the next 36 months. And they increase production from 750,000 ounces to 1.2, right? If you take that 1.2 million ounces, and basically we're speculating, we're assuming, right? And everything stays the same, so their costs don't explode. We don't have massive inflation. And if you do the math, if you take 1.2 million ounces times $6,000 minus the cost. So we'll say, we'll use 3,000, which is really, really high, right? So it gives you $3,000 margin, which is a lot. 3,000 margin times 1.2, that's $3.6 billion in free cash flow. And then put a multiple on that of like 15, and it takes you about $40 billion market cap. This is how I invest. So you take that 40 billion and you compare it to their current market cap. All you have to do is sit back and wait. You're sitting back and you're waiting for the outcome. It's not trading, it's speculating. But if we're right, we get paid. And so it's speculating. We're speculating on Equinox executing, expanding production, keeping costs under control, and then the gold price goes higher. You can do this. You can speculate this way, but you don't do it over 12 months. They got to grow production from 750 to 1.2, which is going to take them 3 years, maybe 4. But if they get there and gold gets to these high levels, the returns are really good. And the one that I'm explaining here is a major. I mean, it's a big company. So you can imagine if you use that same philosophy, that same approach on a company that has a market cap of 30 million, 50 million, 75 million. It gets pretty juicy. It gets juicy in a hurry.
Yeah, I think there's going to be a lot of those companies that may have smaller market caps there, and many people are. I mean, this industry has had a lot of bullishness. Gold and silver are near all-time highs in dollars. You got new investors that are going to be there, as well as new companies that have come online and such. And so I'm sure people are going to be thinking about, okay, how do I know
what to buy? Is this a good company? Is this a good company or not? Read Don's book. Read Don's book. He'll help you figure that one out.
Yeah, for sure. So you have a current edition of that out right now.
Yeah, the 11th edition's out, but wait for the 12th. It's much better than the 11th. And if you've read anything below the 12th, buy the 12th and read it again. It's got some good stuff.
Yeah, that's good. Okay, so silver, we've breached $90 an ounce, which it's been fast. I think before Christmas time it was at 75, somewhere around there. Then it got kind of crushed down to 70. Paper market, kind of interference and such, and then now it's at 90. I'm curious in your perspective on silver, especially because the paper market, narrative has been huge, especially on X and such, and I think it matters, but it seems like it doesn't matter in the grand scheme of things because silver still keeps screaming higher. Like it happens overnight during illiquid hours, and then the price of silver just skyrockets again. Right. And so it seems like the paper markets are losing a lot of leverage in this.
Yeah, it's. I would say that the gold is kind of big brother and silver's little sis, and gold is kind of the masculine metal. In astrology, gold is Leo and it's the sun, and so that's the masculine side, and silver is the feminine side. It's Cancer and it's the moon, and so you can't understand silver. Silver's impossible to understand. Silver I call is the drama queen, but it's always but it's always about gold. The story is always about gold. Gold's the big leader. Gold is the king. Gold's on the throne. Silver's more the queen, right? You never know what the queen's going to kind of do, and so it's all about the S&P 500. Which is, we watch that number one. That chart's most important. That's what's driving gold. It's going to drive gold up. It's going to drive gold down, and then they'll decouple. But it's all about right now. It's all about the S&P and gold. Silver is over here on the side. It's the side story, if you will. It's the drama queen. But as I wrote, the first edition of my book, I wrote in there that there's going to be a shortage of silver. There's going to be a shortage because there's just not enough silver for both fabricators, which need about 70%, which need about 700 million ounces a year. It's a lot of silver that's necessary for solar panels, for any type of vehicle, phones, anything electronic. So silver's, it's got massive, industrial needs, if you will. All your military is all silver. And so, then once the investors say, well, we want some too, at that point, there's not enough. And so silver, once it got above $35 and below 30, and nobody cared about it. There's no interest, just the small little retail crowd, the silver bugs. There's no interest really. Once you got above 35, all of a sudden it became a monetary metal, and now the investors are here to buy it. At that point, silver ripped from 30. It was at 35 in August, early August, and off to the races. It went to 40, 50, 60, 70. It's just been going. So we got September, October, November, December, 4 months, 4.5 months. It's went from 35 to 90. It's up 25% in 2 weeks. It ended the year at 70. It's at 90, up 25% in 2 weeks. And the reason why is because there's not enough of it. So we have this big problem with inventory levels, and but silver is going to be uber volatile. You're not going to get a free ride on silver because that's not how it works. Silver is going to be volatile, and I'm going to tell you why it's going to be volatile. There's lots of reasons for silver to get whacked, if you will. The first reason is, and I don't know when it's going to happen this year, but I expect it at some point, is the S&P is going to correct. And the S&P corrects, it'll pull down gold and it'll pull down silver. And silver, back in October, gold corrected 12%. Silver corrected 18%, so 50% more. So that's kind of what you can expect. Silver's going to, and this time, because silver's outran gold, it will probably correct more than 50% of whatever gold does. But the good news is that gold is so well positioned this year that I don't think we have to worry about more than a 12% correction. I mean, 15% outlier at worst case, but that would be very short-lived. But the more likely scenario is gold only goes down like 8 to 10 this year. And when it does, everybody's going to know this is a buying opportunity. Gold is the new buy the dip asset. And it's going to become very obvious this year, especially how fast this thing bounces. And so if they can't hold gold down, then they can't hold silver down. But so that's the first thing that's going to create volatility in silver. The second thing that's going to create volatility is the shortage. I think the shortage could come as early as March. I've been having these conversations with Grok, and we argue. Grok's more pessimistic than me. Grok thinks that the silver inventory problem is going to happen in Q1. I think it's going to happen in Q2. So we're kind of fighting over it. But I'm hoping Grok's right. Now, the reason why Grok thinks that the problem is going to happen in Q1 is that the deliveries are unsustainable. So if you look at the deliveries, historically, the deliveries are like, 15 million ounces, 10 or 15, and at most, even less than that. But at most, you never see it any higher than that. Now we're kind of doubling that and tripling that. And last year, the deliveries last year was, I believe, 90,000 contracts. That's 450 million ounces. That's more silver than is currently, on the COMEX. And for March, so they have what they call these major delivery months. So, and the first really major month of the year is in March. Normally, January and February are not big months, but this is an unusual January. Deliveries is going to be around 20 million ounces. So we get 20 million in January. We're looking at 50 million plus in March. That's a lot of silver delivery. And so everybody knows that it's coming. And so last year we had approximately 200 million ounces of a deficit. So in other words, investors, it was all investors, right? Supply is about 800 million ounces. That's plenty for fabricators. That's plenty. So we didn't have a deficit for the fabricators. The deficit is all investors. It's all investors, right? We had 200 million deficit last year. So the supply is around 800 million production, 200 million recycling, and then deficit of 200 million ounces, which came all out of inventory. So we had, the last 3 years, I think that the deficit 600 million ounces. Last 4 years, 600 million ounces. This year, 2026, it's estimated that the deficit is going to be 300. So it's going to be somewhere between 250 and 300 million ounces of silver that has to come from above ground inventories. There's not very much left after 600 million ounces over the last 4 years. So this is the reason why Grok is so pessimistic about Q4. And so this is where we get volatile. Government is going to have to do something to create inventory because you cannot have shortages of silver. And the reason why is, number one, the economy, right? You can't shut down GM's plant. You can't shut down iPhone's plants, right? You can't shut those plants down. They got to have silver, right? So they're going to have to find, but the other one is military applications, right? Military, you can't shut down, production of military. So there's these massive incentives for governments to figure a way out to create inventory. And so that is coming. And when it happens, but the one thing about that is it's dicey. It's not cut and dried. In other words, they can't just take inventory away from retail easily. And the reason why is because the biggest buyers of silver is India and China. And so they try to cut off retail purchases in the West. They're like, China and India goes, thank you very much. We'll take it. In other words, they're not going to stop. India is a perfect example. They're not going to say to their consumers, we're not going to let you guys buy any more silver. That's not happening. It's part of their culture. Yep. It's part of their culture. They're going to allow their citizens to buy silver. So, hey, that's great. U.S. citizens, they can't buy silver anymore. But we can. That's beautiful. Thank you very much. So it's kind of a, chop off your nose to spite your face situation. So it's going to be really difficult. So cutting off the retail trade. The other one, which I think is the low hanging fruit, is to basically force the ETFs to basically, close down and then dump all their silver on the market. That's the low hanging fruit. The other one is JP Morgan has a big inventory. So they basically tell JP Morgan, hey, look, you don't need that asset. You're just making money. Sell that to us. So I think that is the lowest hanging fruit because that literally has no ramifications. That doesn't hurt anyone. Whereas if they shut down an ETF, that creates a lot of pain because that's basically the government taking away someone's assets, infringing on your rights. But at JP Morgan's inventory, that one's low hanging. That one's the lowest of low hanging fruit. So I think that one goes first. They basically make a phone call to JP Morgan and say, hey, we want to buy your silver. And so it'll probably be the U.S. government, and the U.S. government will buy their silver, and then they'll basically say, hey, silver's for sale. Who wants it? Right? And then Trump will use it as leverage over China, and they'll say, look, we got all this silver. We'll sell it to you, but we want in exchange quid pro quo.
Yeah. I'm curious with the so I'm wondering if the government, United States government, would sell it with, it being a critical mineral. And Trump beefed up the national defense budget to, 1.5 trillion and such. So curious there. And then I had a conversation with Jay about silver, and his projection is that the U.S. government is going to get directly involved with silver and these silver companies. And then an article came out recently about the U.S. and J.P. Morgan partnering together for smelting capabilities on a smelter. And so just curious in the United States getting more involved with some of these companies regarding silver And is that something that you're seeing on the horizon in your view?
It's an outlier. It's not an expectation of mine. Right now, all they've been doing is giving companies money. They've been writing them checks. Perpetua was doing an antimony project, and they just basically said, "Okay, here's a check. Here's some money. Get it built." So they've been handing out checks, but they haven't been taking ownership of these companies. So until we see that happen, it's just an outlier event. There's a lot of unknowns, but I mean that's the government trying to get access to inventory. I think the bigger question here is how do they create inventory for fabricators because I think shortages are coming. And so how do they create inventory? And whatever method they use, in theory, it could cause the price of silver to drop. But if they do the JP Morgan thing, I don't know which way it would go. Would silver go up or go down? It's hard to predict.
It depends on how much per ounce they buy it for, huh?
Yeah.
Something like that. Yeah. Okay. Yeah, that's good. What other things is on your horizon, on your radar currently for 2026? So, I mean, obviously you're looking further out. But yeah,
a couple things. So first of all, I feel that the macro situation for gold is just getting better and better and better. And I think that Wall Street, the average consumer, because the average consumer gets their news from mainstream, they don't have time because if you get your news from the mainstream media, you probably think the economy is okay, unless your budget's squeezed and you go, what the hell, I'm not getting paid, But I think the narrative right now is very misleading. I wrote, in my kind of my first newsletter of the year, the January one, that 2026, this year, is the last year of American greatness. I firmly believe that people don't realize it's almost as if we've been on chemotherapy for 20 years with a slow drip, and we've been slowly and slowly getting sicker and sicker. That's how the economy feels to me. And it's like the middle class is being hollowed out more and more and more and more. And there's nothing in place, if you will, to change that. Howard Lutnick said that we're going to bring back manufacturing to this country. The problem is timing. Do they have time to do it? And on top of that, if the Democrats get into power in 28, how incentivized are they going to be to keep this type of a policy in place? This reversal of globalism, this supporting of manufacturing. Yeah. How much time do we have? The problem is it's a ticking clock. I mean, we got the drip of chemo coming in, and we're slowly dying. And it's like, when are we going to get this? This cure? How is the cure? When the cure is like, we're going to bring these plants back, but now a lot of these plants are automated. The AI is making it easier and easier to build stuff without humans. So even if they bring back manufacturing, we're entering an era where you're going to lose more manufacturing jobs than you add through AI. AI is actually a job killer, whereas internet was a job creator. And so, I mean, it's a very high productive tool. Every company is going to be able to use AI to reduce employees. They predict anywhere from 10 to 20% of employees are kind of at risk here. And so, that solution that they're talking about, it's not on the near term horizon. And so the economy is slowly, like I said, I think this is the last year of greatness. I hope I'm wrong, but that's my expectation. I don't think we will be able to get through this entire year without a recession occurring. And so that is very beneficial to gold. That's the reason gold is high right now. The reason why gold is high is because of the fragility of both the U.S. economy and the U.S. bond market. Those two things, and the global South and the BRICS basically moving away from the dollar and moving away from the Swiss system, and creating their own system and slowly creating a bifurcation in international trade. These are bad for the U.S. because the U.S. has dominated all that. And we're losing our customers on our bonds. We've always exported bonds, exported debt. The rest of the world has subsidized our standard of living. When you add it all up, you have to be extremely nervous. Now, I pay attention to these guys that are smarter than me, that have been doing this longer than me. Guys like Ray Dalio, Mark Faber, these guys that have been around the block, and even Buffett, who basically is in all cash, Jeremy Grantham, all these guys that are doing this for, in their 80s. These guys that are basically in their 80s. Stanley Druckenmiller, I think, is in his 70s. But these guys that have been around the block, they're all nervous. Extremely nervous. Not a little bit nervous, extremely nervous. Jim Rogers is another one. They're extremely nervous. They're like, Jim Rogers says this is going to be the worst, economic crisis in his lifetime. That's his expectations. And Grantham is the same. He calls this the most vulnerable market he's ever seen. And if you watch the mainstream media, they're like, everything's fine. They make GDP's at 5%. Everything's fine. Everything's great. But guess what? Those GDP numbers are the one thing about government numbers is they are so misleading. GDP is benefiting because imports from China have dropped dramatically. If the imports from China go up, GDP goes down. I mean, irony of ironies. But without those high imports from China, the retail market, their revenue is going down, right? Because they have less product to sell. And it's very ironic. And then the CapEx spending on all the data centers, that goes to a very small group of people, right? It's a very small segment of America, right? And that's a big chunk of GDP. So you have to normalize it. You need to normalize GDP, and you need to normalize employment. You need to look at the holistic picture. You look at the whole thing. And when you look at the whole thing, it's really ugly. Like I said earlier, for gold, in order for gold to really stay flat or go down, you need some vibrancy in the economy, some vibrancy. And there really isn't any. I mean, healthcare is hanging on because healthcare is subsidized, but housing and construction are not healthy right now. And AI is basically kind of rug pulling the American, workforce. I wouldn't be surprised if right now somebody could come up with a chart that shows the number of jobs that are being lost every single month because of AI. It's more than 10,000, right? It's a big, people are losing their jobs every single month because of AI. It's happening. There's no doubt it's happening, right? So there's no vibrancy there. And that's a problem. And that's why gold looks so strong right now, because without vibrancy, if like I said, Trump and Ludwig, if they can't turn this thing around quickly, and Besant, they can't turn it around quickly, the chemo drip's going to get them. And so I actually think that Trump's, could be completely wrong here, making predictions, guessing. I actually think that Trump only has until August 1st to basically put his plans in place. Because once we get to August 1st, the Congress goes on recess. They're usually gone in August. They come back in September. The elections are in November. There's nothing going to get done in September and October. And then the Dems win the midterms, and Trump basically is, it's over. That's how I see it. It's like he's got to do whatever he wants to do. If he wants to buy Greenland, he better hurry up. He's only got till August 1st. The clock's ticking on the guy. And he never had a chance because they gave Trump such a bad hand. Trump was so far behind the eight ball when he got into office. The economy was so weak because of inflation. I mean, first you got to kill inflation, right, before you can kind of turn things around. So we've been fighting inflation his first 2 years in office. There was really nothing Trump could really do to kind of, you don't kill inflation overnight. And so, he couldn't really stimulate. There was nothing he could really do here. Now he's talking about, I'm going to do stimmy checks before the midterms. You know, he's going to try to do stimmy checks here. How in the heck can you do stimmy checks when GDP's at 5%?
Yeah. Same thing. I mean, and then the whole tariff ruling is going to come out soon. I mean, you got he wants to cap the credit card interest, and then I think he bought $200 billion in mortgage-backed securities and such. And so, he's definitely trying to put the money to work and put the policy to work to protect the midterms or whatnot. I definitely see that. I was thinking about with everything that's kind of going on and how you framed all of that, what is he actually going to be able to get done, especially looking at the longer term picture. I mean, it's a 4-year, he has 4 years in office, and then, we're off to another election, which can, the next president come in, if it's a Democrat, they're going to revoke executive orders, and we're kind of back to this reset again. So yes, it's kind of interesting.
This is a very sad situation that we're facing here. In my lifetime, all I've experienced is my standard of living go up. My entire life, 1 year after, it's just up. I mean, it's unbelievable how our standard of living has appreciated, if you will. It's actually fairly stunning how what we've experienced. And so we have a normalcy bias. We think that our lives, if you will, we've created this, now this is for the affluent. These are the people that have been successful, right? Anybody that's affluent, that's, a boomer, if you will, has had an unbelievable ride. And it hasn't really decreased. It just keeps getting better and better and better, right? That's coming to an end. That's sad. And so I think this is the last year, I think, where our standard of living goes up. And now we start going down. And that's a very sad situation. In America, I figured this out kind of in the mid 80s, that America was making really bad choices, if you will. We weren't making choices for sustainability on a societal level. And what I mean by that is we weren't bringing everybody along. I think the Kennedys probably had the best shot of creating opportunity for everyone. And so what we've done, starting in the 80s, is we've slowly squeezed opportunity to a smaller and smaller segment of society. And it's probably about 75-25, maybe 80-20, where depending on your zip code, the chance of you basically becoming affluent was very low probability. And so we started and we reached a point, this is why America is kind of over, if you will, is we reached a point where it got too out of balance, where society said, screw it, we're not going to support America, we're not going to support the Constitution anymore. The Constitution, it only worked for a segment of society. It didn't work for everybody. We're just going to burn it to the ground, screw it. And we've reached that point, America's reached that point where the majority no longer supports the Constitution. Because the Constitution is based on individual freedom, and individual freedom basically creates a situation where people are supposed to be allowed to kind of do whatever they want, succeed on their own, and the government's supposed to stay out of the way. And now the majority basically say, no, that doesn't work. We can't allow that. We can't allow individual freedom to run amok because there's too many people being left behind. And that's the point. And so we've gotten out of balance where the majority no longer support support individual freedom. Perfect example is COVID, right? The majority said, do what the government tells you, take the shot, right? That was kind of the big signal, the big warning that America's done. You mean to tell me that I'm going to lose my job if I decline to put something inside my body that I don't think's good for me? that was kind of the end. That was kind of the end point. And now, and now we've reached that point. We reached the point of no return. And so now, like I said, I think the majority of the country no longer believes in basically what the founding fathers, the original intent of the Constitution, which was, if you read it, individual freedom. I mean, that's what the Bill of Rights is. Right to free speech, the right to bear arms, the right to privacy, the right to basically make your own decisions. Right? It's like, no. You don't have that freedom. Remember what Arnold Schwarzenegger said? You don't have the freedom to just choose.
Mm-hmm. Yeah. It's definitely true, especially, and I think even in how polarized things are. Each party wants freedom for their causes and wants to limit freedom for causes they don't agree with. I think that was a big one with the whole free speech. When I saw that was championed, through the campaign and everything, and then I think it was who came out and said, "Oh, free speech is free speech and then hate speech," and then I was like, "Okay, this is kind of interesting."
The biggest rug pull. Which is ironic as heck, was the Republican Party when they did the Department of Homeland Security, and then they did the second one was actually even worse, when they basically said that if you're an enemy combatant, we can arrest you, and there's no habeas corpus, right? Mm-hmm. That's the Fourth Amendment. Yeah, they basically said, Fourth Amendment, we don't need that anymore. That was done by the Republican Party. I mean, what? Are you kidding me? No habeas. No, they're enemy. We can call any American an enemy combatant. That was kind of. I mean, so it's not just the Democrats that have basically been removing freedoms. It's been both parties. Both. They're both. They both kind of rug pulled America. And so, it was called. I call it the American experiment. It was the American experiment on freedom. Individual freedom, it's all about the individual, not my group. My group can have freedom. No. It has to be always on the individual level. What you just said is so pertinent. You said that my group, we get freedom and you don't, right? Yeah. Group freedom. There's no such thing as group freedom. That's an oxymoron.
Yeah, it's definitely. There's a lot of.
We either all get it, or some of us get it. But,
yes, a lot of tribal.
I actually think that kind of 9/11 was kind of a. Woo! We made some really bad decisions there, mm-hmm. And now it's like, Now, the reason why gold is doing so well is both because of our economic choices and our political choices. That's why gold is doing well. It's sad. It's a sad thing. I mean, I invest in gold and silver because I know it's going higher, but it's going higher for all the wrong reasons.
Yep. Yeah, that's real. I mean, and all of this is it's a lot of history here. I mean, George Orwell wrote a lot about personal freedoms. Many other authors. And then when we look at Ray Dalio's work, Neil Howe's work, and such, even Ray Dalio, says hey, this is part of the cycle where we get so top heavy, and then things just start going downhill and such, and this is part of history. So, yeah, it'd be foolish to undermine that, and I think that's the case, and so yeah, appreciate you coming on the show, Don. Obviously, people can go to goldstockdata.com to learn more and to also subscribe and to get your top picks because you're doing the research, you're doing the due diligence, and not everybody has that time to do all that work you're doing, Don.
Yeah, I've been doing it full time since I think 2019. One thing I want to say about my website, though, my website is for people that already own gold and silver mining stocks. It's not for newbies don't know anything about it, and they're just going to come to my website and find picks. I'm not a newsletter writer who basically writes up companies and says, okay, here's the companies to buy. Yeah. I don't include write-ups of companies in my newsletter. It's more of a data. But if you own a gold and silver mining stock and you basically, analyze them, pick them yourself, my website is a fantastic tool to find more.
Yep. That's good. That's good. All righty. And that's a way. I mean, the stocks are leveraged and an accelerator. Some people are stackers. I've been talking to a few stackers, and I have physical metals too. But I'm also thinking about how the physical metals don't multiply themselves. And so if you find a really good company that can outperform and give you significant gains, I mean, we've seen quite a few companies outperform the physical metal this year. You know, that profits could be taken and put into the physical metal, and you would get more ounces than you would have just parking that money directly in the physical metal. So, I think that there's a lot of opportunity there to multiply your ounces if you're a stacker. So, a lot of exciting times and such. Appreciate you, Don. Looking forward to seeing you at VRIC, meeting in person and everything. You all be sure to click the link that is pinned in the comments that is to the Vancouver Resource Investment Conference. Love to see you there in person. Don will be there in the flesh, giving a speech and such. And so looking forward to seeing that, and appreciate you for coming on the show, Don.
Thanks. Just one final thing. So on VRIC, I talk at 2:30 on both days in workshop 2. So it's pretty easy to remember. Workshop 2 at 2:30.
Yep. That sounds good. All right, you all. Thank you for watching.